Welcome to the VectorVest special presentation, this week titled, Using Contra ETFs to Hedge Your Portfolio. My name is Todd Shaffer, Manager of Research for VectorVest, and I'll be providing your presentation this evening. You might have noticed recently that volatility is back. Plus 1% daily market swings with 4 reversals in the last 5 days. Even without a directional move, the bouncing can be hard to stomach. Coupled with the Fed's waffling on interest rates and the bad news bulls, it's no wonder investors are nervous. That nervousness increased the inquiries about Contra ETFs as an approach during our weekly coaching sessions. One solution, of course, would be to simply move your portfolio to cash. But you can't make gains or collect dividend income if you sit on the sidelines. There are many reasons why investors who like to hold their positions for the long haul might prefer to try to weather the storm. We've covered the topic of protecting profits many times with option trades, and have even included the techniques in our worry-free investing coursework. While these insurance policy quote-unquote approaches are our favorites, some might prefer other methods of hedging their portfolio using ETFs, specifically Contra ETFs. Let's begin with a quick review. An ETF, or exchange-traded fund, tracks an index, a commodity, bonds, or a basket of assets like an index fund. Similar in concept to a mutual fund, unlike mutual funds, an ETF trades like a common stock on a stock exchange. ETFs experience price changes throughout the day as they're bought or sold. As an example, if the S&P 500 index rises 1% in a day, an ETF that tracks that index should also rise 1%. A Contra or inverse ETF is an exchange-traded fund constructed by using various derivatives for the purpose of profiting from an inverse or opposite move from the value of an underlying benchmark. Investing in Contra ETFs is similar to holding various short positions, but unlike short positions, they're bought long and do not require the use of margin. They can therefore be traded in many tax-protected accounts, in particular IRAs and 401ks. As an example of Contra ETF's performance, if the S&P 500 index falls 1% in a given day, a Contra ETF that tracks that index should instead rise 1%. Both regular and Contra ETFs have versions that add leverage to their objectives. These funds use derivatives to provide double and triple the daily return of any given index. Of course, all Contra ETFs are designed to profit from the decline in a sector or market. Like other derivative-based ETFs, these leveraged funds are used primarily by speculators and momentum players that frequently hold on to these positions for no more than a few days. Which is a nice way of saying the leverage reintroduces the volatility we were trying to avoid in the first place. So this translates into broad price swings and gapping price action. To help you visualize this concept, when the market falls 1%, our Contra goes up 1% if it's non-leveraged or regular, 2 times if it's double leveraged, or maybe even 3 times if it's a triple leveraged Contra ETF. But remember, nothing comes for free in the stock market, and that 3 times performance comes with 3 times the price swing or volatility. Well, the next question is, where do we find them? Let's move into the program. From the home page, if we click on the Viewers tab, we have in the Viewers section an ETF viewer which houses all of the ETFs. Of course, clicking on this will bring them up in VST order, but we'll have mixed all the leveraged and non-leveraged ETFs, both Contra and regular, and ETFs from all the many industries. We can also go to the sector viewer and choose the ETF sector that houses all the ETFs. If I double click on it, then I can see the 35 ETF industries. One of those industries is called ETFs Short, which holds all of the Contra ETFs. But an even better method of organization is found in the watch list section of the Viewers tab. Here you can see there's an ETF section of watch lists. In this group, we have many watch lists that organize the ETFs around different organizing principles. For instance, whether they're leveraged 2 times or 3 times, whether they're Contras or regulars. We have them organized by the vendor who offers the ETF or supports it. Of course, you can build your own custom watch list to organize them however you like. Let's look at our non-leveraged ETFs regular group. One of the first things you might notice about ETFs is that they all have an RV and RS value of 1. That's because we don't know the internal makeup of these ETFs, if they even hold stocks, and so they have no fundamental measurements. So we give them all a score of 1, which means really their VST score is largely driven by their RT score. Another key thing to understand about ETFs is as we scroll over to the average volume, some of these ETFs have very thin volumes. So you want to make sure that you look for sufficient volume to assure yourself some liquidity when it comes time to sell. And finally, scrolling back over to the name column, the name conventions are fairly complex as we're trying to get not only the vendor's name but also the underlying benchmark and the leverage all into that name. So when in doubt, simply go to that line, right click on that line, go to the full stock analysis report. At the head of the report, we'll give you in the business description the full name of the ETF and the underlying benchmark it tracks with or without leverage. Of course, there are a lot of folks who trade ETFs themselves for both bull and bear markets. And of course, the Contras, even the leveraged, can be traded in down markets all on their own. But they can also be used to some effect as hedges for market downturns. What do I mean by hedge? Let's go back to the slides. A hedge is an investment to reduce the risk of adverse price movements in an asset. Normally, a hedge consists of taking an offsetting position in a related security, such as an option contract. A perfect hedge is one that eliminates all risk in a position or portfolio. In other words, the hedge is 100% inversely correlated to the vulnerable asset. Of course, it also fully offsets gains. This is more an ideal than a reality. Even the hypothetically perfect hedge is not without cost. Basis risk refers to the risk that an asset and a hedge will not move in opposite directions as expected. Basis refers to the discrepancy. Our goal is to minimize the basis risk. And so let's demonstrate that, and I'll use our quick test function to assess our correlation. I'm back in the program. Let's go to the Unisearch tab. And I'm going to run a search called CC S&P 500 Winners. This is one of our surefire searches. It looks for S&P 500 stocks. As we see here in the search parameters, those stocks should be buy rated, have minimum price and volume requirements, and they're sorted by high actual price with low T ratios. So because these stocks are all on the S&P 500, I should have a pretty good correlation with the index, even though I'm only going to take 10 of 500 stocks. So for this demonstration, I'm going to run the search on some specific dates. Let's go back to the market timing graph to show you how I selected those dates. Here's the market timing graph, price only, over the last year. I'm going to zoom into this time frame where we had the worst downturn in the last year. And I'm going to build a worst case scenario going from the top of the market here on 11/4 to the bottom of the market on February 11th. So let's plug those dates into Unisearch. I'm going to run our search on November 4th. And these were the stocks that the search found on that day. We're going to take these 10, we're going to take these top 10 and run a quick test from the top of that market on 11/4 to the bottom of that market on February 11th. So here we see, as probably you expected, the basket's down 18.23%. That corresponds or correlates with the broad market as measured by the VVC, which was down 14.28%. So this test would indicate a basis risk of about 4% between the VVC's performance and this basket of stocks. We can also compare the basket to the S&P 500, which fell 13% in that time frame, about a 5-point spread. The non-leveraged Contra ETF for the S&P 500 is symbol SH. I should say it's just one of several offerings within the industry, this one offered by ProShares. So we see, because this is a Contra fund now, instead of falling 13% in the same time frame, it gained 13%. There's a 2 times leveraged version called SDS. It went up 27.27%. The triple leveraged ETF, SPXU, went up 41.34%, more than 3 times the S&P 500. You might have noticed it wasn't a nice linear progression. As we introduced more leverage, then we've got more variation in the price performance. So let's see how this applies to our hedge. If I wanted to hedge my entire $50,000 portfolio with a quote-unquote perfect 1-to-1 regular Contra ETF, I'd theoretically get $1 of gain in the Contra for every $1 of loss in the portfolio. And here the downside of this approach becomes clear. It's capital intensive. Leverage lowers the outlay but does induce more basis risk or slippage. Another benefit to this approach is that it's very flexible to rebalancing as stocks are added and or removed from the portfolio. Of course, this method is also restricting any gains that we're making that we would otherwise make in the portfolio. To illustrate this idea, let's move back into the program and we'll use our back tester. For this demonstration, I'm going to repeat our quick test as a back test so that we can see the equity curve and get some performance data. So to do that, I'm going to click New, and we'll give it a name about S&P 500 Hedge. We're going to edit our account settings. We'll take off the commission load just to keep things even on par. And we'll execute at the current day's close. Click OK. Now we need to design our trading plan, so we're going to build a custom trading system. Let's just turn off market timing. We'll stay long the whole time. Automation rules. Let's find CC S&P 500 winners. Our stop criteria will be none. More settings will hold 10 positions. And of course, we won't have to replace anything because we're not using stops. So we'll click Finish. We'll set our dates November 4th through February 11th. Click OK and Finish and Run. Of course, it shouldn't be too surprising that we see the loss just as we did in our quick test. Here we have our performance numbers. We lost 17.5% in the time frame. Maximum drawdown 19.36%. So next, let's introduce our hedge. So we'll click Copy. We're going to have to change our account settings to increase our buying power from 100,000 to 200,000 because I'm going to do a 1-to-1 hedge, which means I have to put as much money in the hedge as I have in the portfolio. Let's change our name. To hedged. I need to change the trading system settings. On the More Settings tab, let's make sure that we check that we're going to invest only $10,000 in each position. All of our other settings will stay the same. We'll click Finish, and we'll click Finish Execute Manually so that we can insert our hedge trade. So here we are set to go. I'll click Manage Portfolio, Add Trade. I'm going to start with our regular Contra ETF, SH. That has a price of $40.92 per share. So if I take my portfolio value of $100,000 and divide that by 40.92, I need to buy 2,444 shares of SH. You can see that rounds out to $100,008. We'll apply that, click OK. And so we'll insert that order into the front of the test, and let's hit run. You'll notice a significant difference in that equity curve, yes? So we see price actually traveled flat because we were fully hedged. It didn't retreat, but it didn't really advance either. We started getting some bigger swings in here toward the end of the test, but ultimately our gain loss came in at a negative 0.5%. The drawdown fell to 3%. Let's compare. I fixed the name to reflect the hedge that we have employed here. But comparing the numbers, we had a 17.5% loss unhedged, which essentially was eliminated. The maximum drawdown, the reduction in volatility, fell from 19.36% at its worst to 3% at its worst. In the interest of saving time, I've done through the magic of time-lapse photography the hedges for SDS and SPXU. Let's take a look at those. Beginning with SDS, because SDS is a 2 times leveraged Contra, we only had to put in half of the amount of money, so we put in $50,000 buying power, additional buying power for the hedge. But again, a significant drop in the drawdown and the losses. Again, our losses dropped from 17.5% to 1%. The drawdown from 19 1/3 down to 4.5. Finally, the XPXU hedge, our triple leveraged, only required $33,000 of buying power be added. Again, it mitigated our losses with a drawdown of 5.19. Notice that the drawdown gets broader the more leverage we have and the more slippage we get in our basis. Of course, you don't have to use the quote-unquote perfect hedge where you try to eliminate all losses. Often it's enough to just mitigate them. In that case, you can place smaller hedge positions or even step in with multiple small positions initially and then keep adding to them should the conditions continue to worsen. So I encourage you to take some time to learn about trading these ETFs, both leveraged and non-leveraged. Of course, exercise caution with the leveraged as they can have some more volatility introduced because of the leverage. But here we have another tool available to us to help us weather the next volatility storm. That'll conclude our presentation for this evening. I thank you for watching. Have a good night.